What's up, everybody? This is Sunko, the Korean Bro. Today is 2023, May 15. Okay, it's been like 3 weeks since I did YouTube last time, and I feel really great to come back here. Um, Things have changed a lot lately, and I know that there's been up and down in stock market, and uh, I know that mm, I have to catch up with stock news, of course. But then, of course, there are some things I have to catch up with. So I felt like I needed to come back here and read some materials about stock. So I'm here, and let's see what we have. Okay. Is Palantir the best AI stock right now? Let me pick some of the articles first, and then we'll think about it in detail, okay? How are cable companies growing their wireless business so fast? T-Mobile has a guess. Is Sea Limited about to take off again? One unstoppable AI stock to buy hand over fist. 5 smart reasons to buy CrowdStrike stock and one major risk to consider. $1,000 passive income. Yeah. 3 hidden issue retirement to manage this recession together. Bull market territory. Here, what just say? Yeah, it could be worth $15.7 trillion according to experts. Is Palantir the best AI stock right now? Government and commercial business can utilize Palantir's products. Its AIP product has the potential to grow rapidly. The stock isn't expensively priced despite its strong performance. Palantir recently launched a new product with massive potential. Few companies are more committed to using artificial intelligence than Palantir. AI has been involved in every Palantir offering since its inception. It is one of the few companies whose product is built from the ground up to utilize AI. Its latest results were also solid, which begs the question, is Palantir the best AI stock right now? Read on to find out. A vital software for governments and business alike. Palantir's platform is designed to take a vast amount of information, run it through its AI models, and derive actionable insights. Users can also run simulations to understand what might happen if they tweaked some in the operating flow, a vital piece of information for any client trying to improve themselves. Although Palantir has products for mainstream business, it didn't start that way. Initially, its products were solely developed for use by government agencies worldwide, and that portion of its business still make up the majority of revenue. This is a key customer base, as multiple governments, including the United Kingdom and several departments within the U.S. government, like Department of Defense and State Department, utilize Palantir's products and have integrated Palantir systems deeply enough that it would be challenging to drop Palantir. This cohort isn't stodgy either. Government revenue rose 20% in quarter first, while U.S. spending rose even faster at 22% year over year compared to commercial revenue, which only rose 15% in quarter first. The government business remains a vital piece of the puzzle for Palantir. But Palantir recently announced a new product that could be a game changer for government and commercial customers alike, a business-focused chatbot. In its earnings call, CEO Alex Karp discussed its artificial intelligence platform, a product he stated he could demand for, of which is nothing I've ever seen in 20 years of being involved in Palantir. AIP is Palantir's take on the ever-popular generative chatbot, but focuses on telling its users what they should do in a particular situation. To power this generative bot, Palantir uses the data its customers already have in their system, making the rollout smooth. For example, Palantir rolled out a pre-release version of AIP in a few days for a major insurance company to automate claims processing. That's high expectations for salmon, but with solid demand already appearing, Palantir may have stumbled onto a product line with game-changing potential. But are the finances good enough for Palantir to be a viable investment? Palantir. Palantir is becoming more profitable. Palantir is currently turning the profitability corner and succeeded again in quarter first by posting a second consecutive quarter of $0.01 per share earnings. While that's not a massive figure, it shows Palantir's commitment to its goal, and investors should applaud that. Looking forward to the rest of 2023, Palantir bumped its revenue guidance up by $5 million to between $2,185 million and $2,230 million compared to the guidance it gave at the beginning of the year. But what was impressive was its guidance change from a GAAP net income for an entire year to GAAP net income every quarter. This shows management is confident in its efficiency strategies, an excellent sign for investors. All of this fantastic news sent Palantir shares up 23% following its earnings release. But even with this jump, Palantir stock looks reasonable, even for a software stock. 45 times forward earnings isn't bad for a company that's still improving its margins, and 10 times sales is exactly what you would expect to pay for a well executing software stock. Because of its valuation and potential for upside, Palantir looks like a great stock to buy here, and is an excellent way to invest in the AI revolution. Let's see what let's see how uh, hmm let's see. Kathy Wood has built a reputation as one willing to bet on the disrupt tech and potential game-changing stocks. Whether her choices have easily outperformed, as was the case during the pandemic or badly trailed it, as happened last year. So far this year, Wood's flagship fund, the Art Innovation ETF, has done rather well, showing year-to-date gains of a market-beating 24%, although the ETF still remained some distance off the highs notched back in February 2021. Hmm. Um, as someone who goes against their grain, Wood is also known to be a bit of a contrarian, and not everyone on Wall Street is always supportive of her stock choices. In fact, Wood has recently been loading up on two equities that the analysts at banking giant Goldman Sachs believe are not suitable for adding to a portfolio at this time. We thought we'd get the lowdown on the pair and have opened the TipRanks database to see what the rest of the street has to say about these choices. Here are the results. Palantir Technologies. Kathy Wood's favorites are often companies operating at the cutting edge of tech, and the first name we'll look at offers just that. Palantir is described as a big data company as it specializes in providing software solutions that help organizations manage and analyze large and complex data sets. The company's software is designed to handle massive amounts of data. It can process, store, and analyze it in real time. This enables clients to identify patterns, uncover insights, and make data driven decisions in a more efficient and effective way. Such a proposition has proven to be particularly valuable to governments, who have been the main revenue source for the company. The commercial sector has proved harder to crack, although the company has been making a concerted effort to gain more share of the market. Nevertheless, the government sales accounted for the bulk of revenue gain in the recently released quarter first report. Total revenue rose by 18% year over year to $525 million, while beating the street's call by 19.25 million. Of that, the government revenue accounted for $289 million, and commercial revenue $236 million. Hmm. Is Sea Limited about to take off again? Sea Limited just raised the pay for its employees. The move comes after more than a year of severe coach layoffs, market exits. It's a highly encouraging sign after Sea achieved its first profitable quarter. In a show of confidence, CEO Forrest Li is raising employee pay by 5%. There was perhaps no bigger poster child for the pandemic boom and bust cycle than Sea Limited. But during that time, the Southeast Asian super app rode massive growth across its stay-at-home portfolio of e-commerce, gaming, and fintech business. Yet, as the pandemic faded and inflation rose, the profitable gaming division, led by global hit Free Fire, declined, sending Sea deeper into company-wide operating losses. As a result, Sea's stock plunged nearly 90% at one point from its 2021 peak to last October's lows. Management responded by aggressively cutting costs and scaling back Sea's geographical ambitions to focus on its core markets. And after a year of painful cutting, Sea posted a surprise first-time profit in the fourth quarter last year. Now, just before first quarter earnings, management gave investors a new sign that Sea's turnaround may, in fact, be solidified, raising pay by 5%. In a memo to employees seen by Bloomberg on May 8th, CEO Forrest Li announced an across-the-board 5% pay raise for Sea employees who joined the company before March 31st, beginning in July. According to Bloomberg, Li feels comfortable that the company has achieved self-sufficiency, a goal Sea's management set for itself a little more than a year ago and achieved earlier than anticipated. Li defines self-sufficiency as the ability to grow Sea's cash balance every quarter rather than having it shrink. Surprisingly, Sea achieved positive net income in the fourth quarter, a stark turnaround from the early part of 2022 and the first such quarter in the company history. How Sea did it. Sea has burned through lots of cash since its founding in 2009, its 2017 IPO, but it didn't waste those dollars. So during that time, the company developed the massive video game hit in Free Fire, and its Shopee e-commerce platform surpassed incumbents to become the leading e-commerce platform in Southeast Asia, cracking the code on how to deliver goods efficiently in complicated emerging markets. Operating with a moat that had just been fashioned over a mere decade, Sea was able to both raise the fees it charged sellers and cut back severely in Coach in 2022. The aggressive moves worked. Sea's revenue grew to 7% in the fourth quarter, a much lower figure than those of the go-go days during the pandemic. However, thanks to its vigorous cost-cutting efforts, the Coach revenue actually declined 8.2% at the same time. Now that Sea has proven it can be profitable at its current size, management might pursue more growth, albeit more efficiently. After all, the 5% raise for employees is emblematic of management's comfort that the company won't run out of money. While top-line growth might not go back to the triple-digit figures seen during the pandemic, investors should expect more of a balance with positive profits, but perhaps a pivot to investing for growth greater than last quarter 7%. If growth reaccelerates and Sea can maintain profitability, Your stock could very well experience another growth spurt. Investors will find out more when the company reports first quarter in earnings tomorrow. One unstoppable AI stock to buy hand over fist. Duolingo is revolutionizing language education with artificial intelligence. The company consistently beat its financial guidance in 2022 and carried that momentum into quarter first 2023. Duolingo stock has soared 100% this year, but the company has barely scratched the surface of its addressable market so far. Duolingo stock has doubled this year and is probably going higher. The technology industry is off to a hot start in 2023, with Nasdaq 100 index climbing 23% so far. Investors are growing even more optimistic about this sector because many companies have just reported better than expected financial results for the quarter ended March 31st. Duolingo is one of them. It crushed its prior guidance for revenue and profitability, and the company gave investors more information about how it's deeply integrating artificial intelligence to cement its leadership position in the digital language education industry. Duolingo stock has soared 100% year to date, but here's why it might go even higher. Duolingo is taking education to the next level with AI. Duolingo is the largest digital language education platform in the world. It uses a mobile-first approach, placing an interactive, engaging, gamified learning experience right into the pockets of its users so they can improve their language skills on the go. Duolingo users complete 1 billion exercises on the platform each day. So the company has a trove of valuable data at its fingertips. Thanks to the rapid advancement in AI, it's learning more from the data than ever. The company has been working on its own AI initiatives for a decade, but it's partnered with a ChatGPT creator OpenAI back in 2021 to supercharge its efforts. OpenAI's newest GPT-4 technology has been nothing short of revolutionary for Duolingo. It can craft these sentences that form each course, so Duolingo's expert team has more time to focus on other impactful improvements to the platform. Plus, GPT-4 is powering two new features called Explain My Answer and Roleplaying, which are only available to users who sign up for the paid Duolingo Max subscription. Okay, why Duolingo stock is a buy right now? Here's the cherry on top for investors. The above results prompted Duolingo to increase its full-year revenue guidance for 2023. Now estimate it will bring in $5.9 million compared to $498 million when it last issued the guidance. It also upped its profitability forecast. Despite its incredible progressive forward, Duolingo has barely scratched the surface of its opportunity. It believes over 2 billion people are learning a language worldwide, and that as the technology continues breaking down borders, demand for education in global languages like English will likely only grow over time. Many artificial intelligence software applications are looking for a use case. In other words, developers have built this incredible technology but haven't entirely figured out how to monetize it. Duolingo is actually putting AI to work at the coal face of its business. It's already making a financial contribution. This company is a great bet for investors who want AI exposure in their portfolios. Duolingo stock has soared 100% in 2023. It's only May, but it remains 28% below its all-time high amid the broader sell-off in the tech sector. Okay, CrowdStrike. The Cloud Sentinel is set to deliver handsome gains to its shareholders. If you're looking for a way to profit from the booming demand for cybersecurity services, look no further than CrowdStrike. Here's why the Cloud Guardian stock could be great buy today, and also key risk that investors should know. A massive expansion opportunity. Effective cyber protection should only grow in importance as more businesses digitize their operations and shift their processes to the cloud. Companies that provide these organizations with the means to protect their most valuable data are thus likely to enjoy rising demand for their services. The global cybersecurity market is projected to exceed $256 billion by 2028, up from $162 billion in 2023, according to Statista. Within this fast-growing industry, CrowdStrike is targeting an addressable market of $158 billion by 2026, with trailing 12-month revenue of $2.2 billion. The Cyber Sentinel is just scratching the surface of its long-term growth potential. Valuable digital real estate. CrowdStrike is a leader in endpoint security. Its Falcon platform defends against the threats at the device level, such as smartphones, laptops, and Internet of Things sensors. Hackers use these devices as gateways into their targets' networks. Roughly 90% of cyber attacks originate at endpoint, which in turn account for 80% of the sensitive data lost in security breaches. This is why CrowdStrike refers to the endpoint as the most valuable real estate, not with the security. It's also one of the reasons why cyber specialist services are quickly becoming a vital part of a well-structured digital security strategy. An AI-powered edge, CrowdStrike uses artificial intelligence to strengthen its threat detection network. Cutting-edge machine learning technology enables CrowdStrike to detect the most worrisome threats and issue real-time alerts to its clients. The company surveils more than 2 trillion cyber events per day. The more data it collects, the smarter it becomes at identifying risk, and the better it can protect its customers. Sizzling customer growth. CrowdStrike technological leadership is helping it win new business at an impressive clip. Its customer count jumped 41% to 23,019 in fiscal 2023, which ended on January 31st. Better still, CrowdStrike is successfully expanding its relationship with its existing clients. More than 60% of its customers now use 5 or more of its cybersecurity modules. Evidence of CrowdStrike's strong customer satisfaction metrics can also be seen in its startling net dollar-based retention rates, which have consistently remained above 120% in recent years. Towards sales and cash flow growth. These customer gains are fueling a sharp improvement in CrowdStrike's financial position. Its revenue surged 54% to $2.2 billion in fiscal 2023, while its adjusted earnings per share soared 130% to $1.54. It should be noted that CrowdStrike is not yet profitable. Based on generally accepted accounting principles, it generated an operating loss of $190 million in fiscal 2023, but the company does produce robust free cash flow to the tune of $677 million over the trailing 12 months. CrowdStrike's profitability and cash production should continue to improve as it scales its operations. Management sees revenue and adjusted profits rising roughly 33% and 49%, respectively. In fiscal 2024, the company is also targeting free cash flow margins of over 30% in the coming years. Investors should also note that competition is intensifying in the cybersecurity arena. CrowdStrike has formidable rivals, most notably Microsoft. The software giant is not to be taken lightly. Microsoft has entrenched relationships with countless corporate clients. It also has tens of billions of dollars in cash reserves it can use to fund its massive research and development program. And yet, 8 out of 10 corporations choose CrowdStrike cybersecurity solutions over those offered by Microsoft in head-to-head tests. This impressive win rate is a testament to the CrowdStrike superior endpoint security technology. It's also an excellent sign that the Cloud Defender's rapid growth is likely to continue in the years ahead. what else do we have? A bull market is coming. One supercharged growth stock to buy hand over fist before it soars 164%, according to Wall Street. Exact Sciences has been hit hard by the challenging economy over the past year or so. Recent strong results have investors thinking the selling has simply gone too far. Given the multiple catalysts that could fuel a rebound, Exact Sciences still look relatively too cheap. The stock has been crushed by macroeconomic headwinds, but could rebound big time if analysts are right. There's a little question that the surest path to long-term wealth generation is investing in the best companies and holding them for years, if not decades. That said, um, investing isn't for the faint-hearted. The Nasdaq Composite has been in bear market for nearly 18 months now. The tech-centric index is still down 23%. Yet history is clear. Every bear market has been followed by a bull market. Experienced investors know that if they keep their heads and continue to invest in top-notch companies through the downturn, profits away when the market inevitably recovers. Calling the bottom is notoriously difficult, so the best time to buy is now. In fact, analysts are remarkably bullish about the prospects of one beaten down growth stock, and if Wall Street is right, the stock is set to soar 164% over the next several years. This cancer screening pattern has fallen on hard times. Few words can have a more devastating effect and instill more fear than cancer. Yet advances in technology have led to earlier detection, which in turn dramatically increases survival rates. Exact Sciences is helping to answer the call. The biotech company's growing roster of cancer screening tests have increased in popularity with doctors and patients, helping fuel dramatic stock price gains. The market downturn has been a crucial mistress. The stock remains 49% off its high, but for patient investors, the tide appears to be turning. Exact Sciences. Hmm. Since its inception, the S&P 500 has produced a return of 184% during the average bull market and a positive return during every rolling 20-year period. Warren Buffett has often recommended buying an S&P 500 index fund known through Berkshire Hathaway. Investors who consistently contribute to an S&P 500 index fund can become stock market millionaires given a long-term holding period. Warren Buffett has often recommended this surefire investment strategy. The last 60 months have been rough for investors. Recession fears sent the S&P 500 tumbling into a bear market in early 2022, and the broad-based index still down 14% from its high. This means that $6 trillion has been wiped out by economic headwinds, but the S&P 500 is within striking distance of bull market territory. By definition, a bull market begins when the index rebounds 20% from its low, and the S&P 500 is currently up 16% from the low point it hit last October. Investors should be thrilled by the development since 1957. The average S&P 500 bull market has run for 196 days, producing an average return of 184%, according to data from Yardney. One way investors can capitalize on that information is by purchasing an S&P 500 index fund. Warren Buffett has often recommended an S&P 500 index fund. Warren Buffett is one of the most successful investors in history, and that success has made him a North Star in the financial world. Investors analyze his every word and pore over Berkshire Hathaway's Form 13F filings with the U.S. Securities and Exchange Commission in search of stock tips. Buffett has often said that an S&P 500 index fund is the best way for most investors to gain exposure to the stock market. Buffett himself owns two S&P 500 index funds through Berkshire Hathaway, the Vanguard S&P 500 ETF, SPDR, S&P 500 ETF Trust. They are essentially identical, though I prefer the Vanguard ETF simply because it's the least expensive option. It bears an expensive ratio of 0.03%, so investors would pay just $30 in annual fees of 100,000 portfolio. The SPDR S&P 500 ETF trust bears a slightly higher expense ratio of 0.0945%. Regardless, the investment thesis is straightforward. The S&P 500 measures the performance of 500 largest U.S. companies. Its constituents span all 11 market sectors and represent a blend of value stocks and growth stocks. That makes the index benchmark for the broader U.S. economy, which happens to be the largest economy in the world. To quote Buffett, for 240 years, it's been a terrible mistake to bet against America, and now is no time to start. Um, America's golden goose of commerce and innovation will continue to lay more and larger eggs. The S&P 500 has been a surefire investment throughout history. The S&P 500 has produced a positive return over every rolling 20-year period since its inception in 1957, and there is no reason to expect a different outcome in the future. There remains any investor who buys an S&P 500 index fund today still but guaranteed to make money provided they stay invested for at least 20 years. To quote Buffett once again, I have yet to see a time when it made sense to make a long-term bet against America, and I doubt very much that any reader of this letter will have a different experience in the future. Index funds can turn patient investors into stock market millionaires. The U.S. has suffered several bear markets and recessions during the last 2 decades, but the S&P 500 still produced a total return of 556%. During that time period, investors who regularly contribute to an S&P 500 index fund can expect similar returns going forward. That may not sound like much, but through the power of compounding, annualized return of 9.9% can still turn a relatively small sum of money into $1 million portfolios, given a long enough holding period. And 9.9% annually, $125 invested weekly in an S&P 500 index fund would be worth $103,000 in a decade. Huh. 368,000 in 2 decades, and $1 million in 3 decades. Alternatively, as my colleague Courtney Carson discussed in this article, $500 invested monthly in the SPDR over the last 20 years will be worth $375,000 today. Here's the bottom line. Investors who can regularly contribute to an S&P 500 index fund, buying through thick and thin, will almost certainly be much better off a decade down the road. Moreover, with the S&P 500 index near bull market territory, now is a particularly good time to start buying an S&P 500 index fund. Okay, this is it for today. I feel great coming back here, and I'm planning to come back more often from now on. See you and have a good day. Okay, bye bye.